Today we are Team 3 and we will be presenting on Chapter 4, Accounting for Governmental Operating Activities.
The contents of our presentation covers these 4 learning objectives from Chapter 4. Learning Objective 1 covers the operating transactions for the governmental activities and its appropriate journals in the government-wide and fund levels. Learning Objective 2 covers the general fund closing entries. Learning Objective 5 covers the inter-fund and inter-activity transactions. Learning Objective 7 covers distinguishing between exchange and non-exchange transactions as well as the classifications of non-exchange transactions.
The first learning objective is to analyze typical operating transactions for governmental activities and prepare appropriate journal entries at both the government-wide and fund levels. Now I'll discuss typical journal entries. First is recording the budget. The budget should record the general fund accounts in each governmental fund for which a budget is legally adopted. The year is not needed in the title because estimated revenues and appropriations are closed at the end of the year. Estimated revenues, budgetary balance, and appropriations are recorded in the general ledger. Next is encumbrances and purchasing transactions. This journal transaction shows payment obligations incurred and not yet paid for. Encumbrances and encumbrances outstanding are recorded in the general ledger. The encumbrances ledger with its specific accounts are recorded in the subsidiary ledger. Then, entries must be made to reverse the encumbrances entries for the original estimated amounts. Additional entries to record the actual charges in the expenditures control account and subsidiary expenditures ledger accounts must be made as well. Expenses and assets are also recorded in governmental activities accounts at the government-wide level. For payment of liabilities, the journal entries are recorded in the general ledger because entries to subsidiary appropriation or expenditure accounts were made previously when the goods and services were received. Similarly, the journal entries for payrolls and payroll taxes record expenditures, vouchers payable, and amounts due to the federal and state government in the general ledger. The expenditures ledger is recorded in the subsidiary ledger with all of the specific sectors the expenditures are applied. Another entry is made to record payroll transactions in the governmental activities general journal at the government-wide level. This entry uses the accrual basis and expenses are used rather than expenditures. Accounting for property taxes focuses on recording the property tax levy. The portion of taxes expected to be collected are recorded as revenues, and the portion that is uncollectible is recorded in a contra asset account. The two accounts amount to the taxes receivable account. These are all recorded in the general ledger. Two important terms that fall under property taxes is non-exchange revenue and imposed non-exchange revenue. Non-exchange revenue is when the government receives value without directly giving equal value in exchange, and imposed non-exchange revenue is a category of non-exchange revenue, such as property taxes, fines, and forfeitures. Next is collection of current taxes, which is a fairly simple transaction to record and is just like recording receiving cash for accounts receivable. As for reclassification of current property taxes, this section introduces delinquent taxes. This journal entry reclassifies the taxes receivable account to two new accounts, which are the taxes receivable delinquent and allowance for uncollectible current taxes. A journal entry must be made to account for deferred inflows of resources, unavailable revenues, and decrease the revenues account in the general fund. For the accrual of interest and penalties on delinquent taxes, the accounts that are included are interest and penalties receivable, allowance for uncollectible accounts, and deferred inflows of resources, unavailable revenues. The journal entries for the collection of delinquent taxes are similar to what we have seen when recording interest and its corresponding revenue. This section just includes the account's interest and penalties receivable on taxes, revenues, general revenues, interest, and penalties on delinquent taxes and taxes receivable. When receiving payment on delinquent taxes and its interest, a journal entry to reverse the delinquent taxes and to account for revenues must be made. As for write-offs of uncollectible delinquent taxes, the journal entries are similar to what we would see for write-offs of uncollectible accounts just with new accounts corresponding to delinquent taxes and interest and penalties. Other revenues are from sources such as sales taxes, licenses and permits, charges for services, and more. These are sources that are not measurable until received in cash. Under modified accrual, if revenues are measurable in advance of collection and are available for current period expenditure, they are accrued and recorded in a journal entry. Two important terms in this section are exchange and exchange-like transactions. An exchange is a transaction in which a party receives something of equal value when resources are provided, and an exchange-like transaction is when values are exchanged but are not equal, or the direct benefits may not be exclusive for the parties to the transactions. Lastly is tax anticipation notes, which are short-term municipal securities issued to finance current operations with the expectation of repayment using future tax revenues. Tax anticipation notes are accounted for by calculating the difference between estimated expenditure requirements and estimated resources available.
Continuation of Learning Objective 1 are special topics. Special topics are additional transactions that result in additional journal entries in the General Fund Journal and Government Activities Journal. These activities are usually 1. General fund revisions, 2. Receipts of good in a prior year, 3. Exchange transactions with proprietary funds, 4. Accounting for supplies, 5. Adjusting entries, and 6. Pre-closing trial balance. 1. General fund revisions. These are any amendment of general funds accounts made to reflect their actual amounts. This illustration shows that there is $15,000 more than originally budgeted. 2. Receipts of good in a prior year. When goods are purchased in a prior year or ordered, they are considered encumbrances and they will be recorded as expenditures in the current year when they are received. However, for GovGuam, encumbrances are considered expenditures when incurred. Following GAAP reporting standards, encumbrances outstanding at year end are reported as reservation of fund balances, as illustrated in the image, where they are not considered expenditures or liabilities because they will not be reappropriated and honored in the next year reservations of fund balances. 3. Exchange transactions with a proprietary fund. So exchange transactions with a proprietary funds are reciprocal transactions that occur internally within the government between funds and activities. These transactions include supplies purchased from an internal service fund or services provided by an enterprise fund. 4. Accounting for supplies. The government accounts for supplies using two methods, the purchase method and the consumption method. For the purchase method, the expenditures of supplies is the cost of supplies, and the remaining unused supplies is added to inventory. For the consumption method, the expenditures equals to the amount of supplies consumed. 5. Adjusting entries. In the purchase method, where there are remaining unused supplies, an adjusting entry is required to account for the inventory prior to the closing entries for the general fund. And finally, 5. Pre-closing trial balance. For the pre-closing trial balance, all the transactions of the fiscal year are recorded in the trial balance before closing entries.
Hi, I'm everyone, and I will be going over learning objectives 4.2 and 4.7. Moving on to 4.2, which is to prepare general fund closing entries. When closing general funds, both budgetary and operating temporary accounts must be closed to the appropriate fund balance account. Budgetary accounts are closed by simply reversing the original entry made at the beginning of the fiscal year, as well as any entries made to amend the budget during the year. Encumbrance details are not reported in the financial statements, but disclosed in the notes to the financial statements. Exceptions occur if outstanding encumbrances apply to restricted, committed, or assigned resources. In these cases, the encumbered amount may be reported in the balance sheet as part of that classification of fund balance. And lastly, closing the operating accounts would increase the balance of the general ledger fund balance unassigned account by the excess of revenues and other financial resources over expenditures and other financing uses. And if there is an operating deficit, then the fund balance would decrease.
Moving on to Learning Objective 5, we discuss accounting for interfund and intra and interactivity transactions. Number 1, interfund loans. Interfund loans are loans made by one fund to another. The illustration depicts a loan made by the Internal Service Fund from the General Fund of $100,000. Number 2, interfund transfers. Interfund transfers are amounts transferred from one fund to another. These transfers are not reciprocal in the sense that they will be paid back. The illustrations depict a transfer between the general fund and the debt service fund of $200,000. Note that the transfer transaction records transfers in the transfer in and transfer out accounts, and the interfund loan records the loan in receivable and payable accounts. Number 3, we move on to intra-activity transactions. They are interfund loans and interfund transfers between the governmental fund and the enterprise fund. These transactions are reported in the government-wide statement of net position and statement of activities.
Moving on to learning objectives 4.7, distinguish between exchange and non-exchange transactions. Exchange transactions are defined as a transaction in which each party receives equal value with the resources provided. It contains recognition rules that are generally straightforward. For operating transactions, the party selling goods or services recognizes an asset and revenue when it occurs and when the revenue is earned. The purchasing party would recognize expense or expenditure and liability. And in most cases, exchange transactions of governmental funds would result in measurable and available assets being received or a fund liability being incurred when the transaction occurs and resulting in immediate recognition of revenues and expenditures. Now, the non-exchange transactions are defined as external events in which a government gives or receives value without directly receiving or giving equal value in exchange. It has two concepts that affect a recipient's recognition of revenue, and then these concepts are the time requirement and purpose restrictions. Time requirement relates to the period when resources are required to be used or when use may begin. It determines the timing of revenue or expense recognition, and it affects whether something should be recognized in the current period or deferred to a future period. Now, purpose restrictions refer to specifications by the provider for how the resources are to be used, and it would be reported as restrictions of net position in the government-wide statement of net position or as restricted fund balance in the governmental fund's balance sheet. Moving on to defining the classifications used for non-exchange transactions. Now there are four classifications in the non-exchange transactions, and they are the derived tax revenues, imposed non-exchange revenues, government-mandated non-exchange transactions, and voluntary non-exchange transactions. Now the derived tax revenues consist of sales taxes, personal and corporate income taxes, motor fuel taxes, and similar taxes on earning or consumption, and it can be recognized through assets when underlying exchange has occurred. And then the imposed non-exchange revenues consist of property taxes, most fines, and forfeitures, and it can be recognized through revenues when resources are required to be used or first period that use is permitted. Resources should be listed as available or available when modified accrual accounting is used. Now, the government-mandated non-exchange transaction consists of federal government mandates on state and local governments, and it can be recognized through assets and liabilities during the period when all eligibility requirements have been met, or when resources are received, whichever is first. And then the voluntary non-exchange transaction consists of certain grants and entitlements and most donations, and it can be recognized through the deferred outflows of resources through the payment of resources before time requirements are met, but after all other eligibility requirements have been met. And while I've only mentioned one recognition for each classification, there are other ways for them to be recognized, and these other ways would be listed or shown in the in illustration A41, which is provided here. And this concludes my group's presentation. Thank you for watching.